we're in a presidential election year this year in the US, and so the market tends to perform in those periods. I think over the last nearly 100 years, 3/4 of the time the market has been up in a presidential election year. And why is that? Because effectively POTUS is pumping money into the system. They want to get re-elected, so they'll have spend as much money on infrastructure and any projects, so people vote for them. And really, the concern at the moment is so that's a beautiful setup. But what we've already seen is the market's up. The first quarter's up about a little over 10%. So, we've already had a very strong first 3 months of the year, which may mean that the market's run a little bit ahead of itself.
So can it last?
Well, exactly, can it last? And I think the average increase in those presidential years was about 7.5%. So in theory, we've had more than that. I think it might have run a little bit ahead of itself. I actually still think, with interest rates expected to be cut towards the latter part of this year, 2024 will still be a solid year.
6 months ago, you said you were surprised that you hadn't seen a shakeout on the market, given the withdrawal of all of the pandemic handouts and also the fact that rates were rising. Do you think a shakeout will come?
Well, that's right. I was surprised that there hadn't been more pain. We know the market's cyclical. We know how bull markets and bear markets, and we know the bear markets are very painful. And after COVID, there was some pain at the start of COVID in terms of the equity market, but since then, and the money being pumped into the system, the equity market has performed reasonably well. You look at over the last 2 years, the financial year to date, the market's up solidly. Last financial year, the market was up 14% in Australia, so it's been it's very good. So that was, I just thought there could be some cracks. They didn't end up coming, but now we're sort of in that presidential year, election year, so I think there's more stimulus, and also there's more confidence that we've got on top of inflation. I think back when I was making those comments last year, I was still a bit nervous that inflation, it was going to be stronger for longer. And it looks like that, with a bit of luck, the genie's been put back into the bottle.
Yeah, it does look like rates are on pause if you listen to the majority of economists, and now the next move will be down. We could be in a rate cutting cycle by the end of this year. Will we avoid any kind of shakeout?
Well, unless, the funny thing about the market, it always surprises us. So, unless the market, ends up being a lot stronger, or there's some significant dislocation, maybe inflation maybe the genie hasn't been kept in the bottle. So these are all sort of guesses. So there is still a lot of risk. The tough thing is I'm telling you these risks, and what sort of plays in the back of my mind is when I started in the market in the early 80s, I remember being told by a very experienced person, when I was telling them about my concerns about the market, they say, look, bull markets climb a wall of worry. So I'm giving you the reasons why we may be a little bit nervous, but the bull market does climb that.
And in terms of those worries, does the geopolitical situation play into that worry?
100%. Geopolitical, and then if there's a presidential election, in the presidential election, if there's a new president in the US, obviously he's going to, that sort of puts a little bit more risk on the geopolitical side. The difficult thing is there's always been some unrest on a global basis. But it is concerning, particularly what's happening in Europe, and also what's happening in the Middle East. They're both incredibly traumatic and concerning for everyone. And I suppose when these things are happening, then there's a risk that they escalate, and then you just don't know where it ends up.
Where do you see buying opportunities in this environment?
Yeah, the interesting thing is the sort of the big focus, and I've just spent a few weeks in New York and seeing companies over there, is AI. Now, everyone's talking AI. I remember going to a talk like Paul Keating a number of years ago, he was talking about step changes. He was talking about the internet, how that was significantly would increase productivity. This was in the early days of the internet. Effectively AI is going to do exactly the same. So that's a significant increase in potential global productivity. And obviously that would be reflected in valuations of companies. So the tough thing is we're very early on in that. So where that takes us, and then also because it's been such a focus, the valuations tend to be a little bit on the high side. One sector of the market that has really been neglected, from a global perspective, it tends to be the smaller companies, the valuation gap is significant globally and also in Australia. So they've been left behind. We've all heard about the Magnificent Seven in the US. So they've been leading the market. The good thing more recently, the market in the US has broadened out a bit more from those 7 stocks. And also we've seen in Australia and also over there that the smaller companies are starting to outperform the larger companies, and that's the first time. We think that sector of the market is probably the cheapest it's been for nearly 2 or 2.5 decades. So it's trying to find those. We like trying to find those undervalued growth companies, but not necessarily the large ones. The medium and smaller sized ones that have been sort of neglected by the market.
Well, you mentioned AI. Nvidia in the US really led that AI boom and drove huge gains on the market. I think Nvidia is up 90% this quarter alone. Did you manage to ride that wave?
Oh, no, we tried it. It's sort of like, using an Australian saying is instead of buying the mining company, you buy the company that makes the mining picks to sell to the mining company. So it's in terms of, you tend to find the companies like Nvidia, you are taking a lot of risk because there's a lot of expectations built into those companies. So it's really just trying to find the other companies that will benefit from AI. But not necessarily the ones that everyone's in love with. To me, you've got to be, from an investment perspective, you've got to try to be a bit counter-cyclical.
So we're at your Investor Day here in Sydney. I noticed the audience is made up of an older cohort. Is it harder, given the cost of living crisis, to attract younger investors at the moment?
Yes, I'm sure. And of course, we are in the middle of the day. And so I'd assume the younger investors, they could be watching it online, which we're live streaming it, or they're in the office working and maybe they can watch the tape later. There has been a trend to a lot more younger people investing in the stock market, and that's been pretty much over the last 3 or 4 years since COVID. So that is that's been happening. But in terms of with the financial pressures and how interest rates have increased, I would say everyone in that cohort are finding things very difficult at the moment. When I think about that, and I think of myself in my younger days, it was earn enough money to pay the rent and survive. If I had my time again, I would put some of my money and I remember hearing Sir John Templeton, one of the great US investors, saying that everyone should put 10% of their earnings a year in the stock market, and really to benefit from what Albert Einstein and Warren Buffett quote a lot is, the eighth wonder of the world is that benefit of compounding. So if at a young age you can put some money in the stock market and it increases by, the market say on average 10% per annum, then when you're probably getting to my age, you've got a very big nest egg, and you'll have time to come to investor days.
We hear a lot about boomers versus millennials. Do you think wealth creation is much harder for younger people these days than it was when you were of that wealth creating sort of age?
I actually think the younger people are more in tune, with that. When I was younger, like I remember when I went to university, one of one of my friends at university saying his dad was a stockbroker. I didn't even know what that was. The only reason I was aware of the stock market was because my father was interested in the stock market. So, but I would say there's a lot more younger people that are plugged into the equity market. I think maybe the cryptocurrencies have sort of had a positive impact on the equity market. A friend's daughter that was telling me that she had been playing the crypto market, and whenever she's made any money, she's buying blue chips. And to me, that was that was an interesting strategy for a young person. So I wouldn't have even known what a blue chip was when I was in my early 20s. So to me, they're more plugged in, but the relativities, things are a lot harder now, in terms of your wages versus the cost of buying a house. So to me, unfortunately, they've got the returns they've got to get have got to be better than what the baby boomers achieved.
And what about the use of social media? How do you see that play out in the investment community?
Yeah, well, I mean, that's a really interesting comment, because I've been I've had social media. I think I've had Facebook for 20 odd years. The only reason I created it was because I was at an event where they wanted you to create it, and I think I've got 32 friends. So I really haven't developed that much, but I've just been in the US, and I've met with the largest investor in listed investment companies or closed-end funds globally, based in the US, Bose Weinstein. I also met with a number of other, the other big fund managers. Bill Ackman, who's a hedge fund manager, very successful, looking at floating the largest closed-end fund, that would, looking at an IPO sometime this year, and he's got 1.3 million followers. And the interesting thing is, and talking to some of the more conservative fund managers over there, I realised that media works, but social media is something that you must have in your toolkit if you want to grow and communicate effectively. So, having had Twitter for a long time, having had a handle that I couldn't remember, I've actually 2 weeks ago I bit the bullet and changed my handle to Geoff Wilson Wham, and now I think I'm up to 250 followers. So the plan will be to grow that to the people that are interested in investing, to grow that to 80 to 100,000.
Future Generation is one of your ventures. It relies on pro bono work by fund managers, zero management fees, zero performance fees. Is there a risk that it could then undercut the work of those fund managers themselves, that people will come to Future Generation rather than invest in those funds?
Yeah. When we set up Future Generation a decade ago, that was potentially the risk. What I've been incredibly pleased about is just how the funds management industry has embraced the Future Generation model. So, they're managing. So, Future Gen, between the two vehicles, FGX and FGG, there's $1.1 billion, which is managed by the best boutique Australian managers and the best global boutique managers that we can find, and they're all managing it pro bono. Because it's a portfolio, then it doesn't necessarily impact the individual manager. If it was all just one manager, then of course, if you're an investor, well, I'm better off putting it in Future Gen rather than giving it to that manager. But what it does do, it actually gives the investor effectively a free kick. I mean, it's a win-win-win. It's a win for the fund manager because he actually has an ability to give back to youth mental health and children at risk. That's where the 1% goes. It's a win for the investor because he actually gets a better deal. Most of those fund managers, because they're boutique managers, they charge performance fees, and so that goes to the investor. and 1% goes out to the charities. So, and it's a win for the charities because they get a growing stream of fully franked dividends. And we all know, particularly what we've seen, the cost of living crisis, we're in at the moment, COVID, the mental health and youth mental health. The government has to be spending significantly more in that area.
And you were just in the US, you say. Did you notice a difference in the mentality around philanthropy or giving back there versus in Australia?
They are, they're very focused on giving back. So you're going to any art gallery that everything you see is named. So to me, it's they're very proud, and they're very happy to encourage other people to give. And I think over in the US, if you're on the board of a US charity, you've got a choice. It's give, get, or get off the board. So I actually think, Australia, the charities in Australia probably have to be a bit more demanding on their boards. But also there is a significant mentality difference. We have come a long way. I'd say in the last decade we have. I think it's really positive. The government, one of the government policies they're talking about is trying to double the giving from Australians, or money going to charities between now and 2030. We've put a submission in there. We think they could change the structure of the future gen products, where you could not only have fund managers managing a little over $1 billion for free. In our proposal, we thought that you could get fund managers managing $100 billion for free. Now, if we got to that, and then obviously if that, then $1 billion is actually going to charities on a per annum basis. So, but if we did get to that size, then obviously there could be some, there could be some problems. But you look at the funds management industry in Australia, like funds management, it's $4.5 trillion. So, what's $100 billion? Where $1 billion going to charity a year, in that perspective.
And just to wrap, you're generally seeing that we're not going to see a significant sell-off or downturn, given that we're seeing interest rates likely to come down by the end of the year.
That's right. We're in a presidential election, which tends to be positive for equity markets. US is the biggest consumer in the world. It looks like interest rates will be cut. That's positive for equity valuations. So it looks like, even though the market's been very strong in the first quarter, 2024, it's the year of the dragon. Tends to be a positive year. Will be a reasonable year for equities.
Geoff Wilson, thank you.
Thank you.